is a bit of a run through of what we're going to be talking about today. My name's Claire Finch. I'm one of the financial advisors and an associate director here. I've been here for 19 years. I'm going to be talking to you a little bit about Greystone. Then we're going to come on to talk a bit about the background to inheritance tax and how calculations work. My colleague Paul is going to be doing the interesting bit about the planning. And then James, who heads up our discretionary investment proposition, is going to be talking to you a little bit about that. And
is it urgent?
a bit about Trump markets, James.
Okay.
And for those of you that are here, we'll hope you then join us for lunch afterwards. Okay, so Greystone. Now, a lot of you have been clients of Greystone for many, many years, but we have got some people in the room that aren't clients, and there might be some things that you don't know about us anyway. We're originally established in 1989. We manage client assets of £1.4 billion. As I mentioned, this is what James is going to be talking to you about. We've got our own in-house discretionary proposition. That's actually quite unusual. Only a few percent of financial advisors actually have that in-house and have discretionary permissions. We're really proud to say that of our nearly 100 employees, over 40 of us have worked here for more than 10 years. And of our 20 advisors, more than 15 of us have been here for more than 10 years. Now, you can see from the numbers on there, we've got 20 advisors, but nearly 100 employees. So we've got a very high ratio of support staff to advisors. And we hope that means, sorry, so you can tell me something's not working. And we hope that means we deliver a good level of service to our clients. We've actually just done a client survey, and thank you for those of you that took the time out to fill that in. This was the results. So at a maximum of 5 stars, we scored 4.8 and 4.9 across the board, which we're really pleased with. We've also, over the last year or so, started asking clients to give us reviews on Google and Trustpilot. So we've got 75-star reviews now on Google and Trustpilot. Thank you to anybody that's given us one. For anybody that hasn't, if you fancy it, we've got these little tap signs that you can tap your phone on, and it'll take you through to a link of Google and Trustpilot if you fancy giving us a review. Thank you. But there's been some absolutely really lovely words that clients have written, and it's really touching for us to be able to read them. Okay, so inheritance tax. So quite a few of you might have a good understanding of this already, but I've just wanted to run through the basics to make sure that everybody's kind of on the same page before Paul comes on to talk to you about the planning bit. Okay, so this first point, pretty obvious one, but anything between spouses and civil partners is free of inheritance tax. So any gifts that you make during your lifetime between spouses and anything that you make via your will is completely outside of your estate for inheritance tax. Now, everybody's got a nil rate band, so an allowance of 325,000, and that can be used against any asset and it can be passed to any beneficiary at all. There's also a residence nil rate band of £175,000. So this needs to be offset against a property and it needs to be passed to a direct descendant. So that needs to be children, grandchildren, stepchildren are also included. Remember, anything between spouses is fine anyway, but this is talking about sort of beyond a spouse, who else you could pass the property on to. So this is where the £1 million comes from. So we've got the 325 each, the 175 each, and as a couple, that's £1 million between you. But unfortunately, HMRC does start to take some of that residence nil rate band off you once your estate goes above £2 million. So excuse me, I can't see the screen here. Yeah. So it's reduced at a rate of £1 for every £2 in excess of that £2 million threshold. So as a single person, once your estate gets beyond 2.35 million, the residence nil rate band is completely gone. 2.7 million for a couple. You'll always have the nil rate band, so you'll always have the 325,000 times 2 for a couple, but you could potentially lose all of that residence nil rate band. And any excess is taxed at 40%. So I'm going to talk to you a little bit about some of the changes that have been brought in for the following the budget in October last year. So the first one is that the nil rate bands are now frozen until 2030. So these allowances that I mentioned, this 175, this 325,000, are not going to increase until 2030. Now, the nil rate band's actually been frozen since 2009, so a really long time, 26 years. But in 2017, they did introduce the residence nil rate band, which has really helped. And I've just got a graph here that shows the impacts of these. So the green line shows the actual tax-free amount that people have had over this period of time. So you can see, I mean, this actually starts in 2010 for some reason, but since 2009, these have been frozen. You can see the green line was was straight across. Then you see the implementation in 2017 of the residence nil rate ban here, started off at 100,000, increased to 175 over the next few years. And that's the £500,000 combined allowance there, which you can see has been frozen since 2020. Now, the blue line is, imagine they'd never brought the residence nil rate band in. We'd only ever had the original nil rate band at 325,000, but they'd just always increased that in line with inflation. That's the blue line. So you can see that we're at the point now where we would have been better if they'd just inflation linked the nil rate band. And the purple line shows if we'd had the nil rate band and the residence nil rate band, then it had been increased in line with inflation. You can see that we'd be on track to have £800,000 tax-free per person over the next few years. So 1.6 million for a couple. So obviously this means that just more and more people are being brought into inheritance tax over time. And that is certainly not going to be helped by the fact that pensions are now coming into your estate from 2027. So this is a massive change for a lot of our clients. I mean, if we go back 10 years, pensions were actually subject to 55% tax on death. It was really quite onerous. So we did have, quite a few people that were reluctant maybe to sometimes put money into pensions and thinking, well, it's going to get lost at some point if I've not spent that money. But then Pensions Freedom Act came in 2015 and they said, right, no more inheritance tax. So the only tax currently on pensions is if you pass away before age 75, completely tax-free. And if you pass away post age 75, it's income tax. Well, we kind of thought, well, that's fair enough. You pay income tax yourself to take it out of your pension. So that's fair enough that your beneficiaries pay that. But unfortunately, from 2027, they are also going to be subject to inheritance tax. Now, this hasn't come in yet, so we've not seen the fine detail, but it looks as though it would be income tax and inheritance tax if you die post age 75. And that can have quite a dramatic impact on the inheritance tax situation. So this is just an example client. So it says pre-April 27. So this is the current situation. So we've got a client here who's got £800,000 in a property, 600,000 in investments, 100,000 savings, 800,000 in a pension. So their total assets are 2.3 million. But because the pension's totally disregarded at the moment, only 1.5 million is actually subject to inheritance tax. Now, this is a married couple, so they've got that full £1 million that we spoke about, tax-free. So £500,000 of that is subject to tax at 40%, which equates to £200,000. If we take that same client post-2027, obviously the pensions are now included in the estate, but we've got a bit of a double whammy because not only are the pensions included, but it's pushed the estate above that £2 million threshold where they start to lose some of the tax-free allowances. Now, in this example, the 300,000 over, so we take that 300,000 to divide it by 2, and they've lost 150,000 of the tax-free, which is why we've got £850,000 combined exemptions on the bottom line. So the net effect of that is that we've then got nearly 1.5 million subject to inheritance tax, which is 580,000. So quite a substantial difference. But what neither of these take into account is growth on assets. So even modest amounts of growth over a relatively short period of time can actually make quite a big difference. So if we imagine this same client in 2025, so they've got total assets of 2.3 million, and I've assumed that we project this forward just to 2030, so only for 5 years. And I've assumed that they get 5% growth on their property, their investments and their pensions, and 3% growth on the cash, so nothing crazy, over 5 years. And that has the effect of increasing their estate from 2.3 million to 2.9 million. Now, again, double whammy again, because it's now gone so far over the £2 million threshold, they've lost all of that residence nil rate band allowance. So they now only have their £650,000 nil rate band. So the effect is it's increased their inheritance tax to £909,000. So quite a dramatic increase from 200,000 current situation, because they've got a bit of growth on their assets. The pensions are now brought into the state, and they've lost that residence nil rate band. So the second thing I want to talk to you about, third even, this one's been very widely broadcast. The changes to business and agricultural property relief. So this is obviously where the farmers have been understandably up in arms. So the current position in the UK is that if you've got a business or you've got a farm, 100% of that can be passed on down the generations, and there's no cap on that, and there's no inheritance tax. But from April 2026, only the first £1 million of this will be free of tax. And anything additional will be subject to a reduced rate of inheritance tax of 20% rather than the usual 40%. We've got quite a lot of clients at Greystone that are in AIM shares. AIM shares have been a great planning vehicle for inheritance tax. They're quite volatile, so they're not for everybody. But after 2 years, the money's completely outside of your estate. And unfortunately, from April 2026, that's also included in your estate, but at this reduced rate of 20%. So I've not spoken a lot about the latter 2 points because it's not something that would affect everybody. And I've kind of probably painted quite a bad picture now for Paul to come on and talk to you a little bit about some planning.
Thank you. Thank you. Afternoon, everyone. Nice to see so many faces. Or it was until Claire told you it was my bit that I was going to do the interesting part or whatever. So, well, let's see. Yeah, so my name's Paul. I'm going to look to outline some of the tax planning strategies, tools that we have available to us as clients and advisors. So we've heard from Claire already a bit of an overview in terms of inheritance tax, what it is, how it works, who it impacts, that sort of thing, along with what thresholds, allowances are available, and that those thresholds, allowances or whatever are now frozen until 2030. The pensions will be added to inheritance tax calculations from 2027. Those two factors alone are likely, will significantly increase the number of estates that are subject to inheritance tax going forward. So just to put that into a bit of context, government's own figures suggest currently around about 4 to 5% of estates are subject to inheritance tax. And they feel that with the addition of pensions, that will come to around 10%. Now, that's the public in general. If we look at our clients, a typical advisory firm like ourselves, our clients, we would generally expect 30%, a third of those clients to be subject to inheritance tax on the estate on death. So if we follow that through from what the government was suggesting, it could well be 70% of clients that are ultimately impacted by inheritance tax once the pensions are taken into account, along with the frozen allowances until 2030. So we start to look at the planning opportunities. It goes blank. Oh, there you go. Right. The good news, as well as the slide now working, the good news is that inheritance tax is often seen as a voluntary tax, if any tax can be truly voluntary. And just this quote from Roy Jenkins back in a parliamentary debate in 1986 gives a flavour of that. Inheritance tax is, broadly speaking, a voluntary levy paid by those who distrust their heirs more than they dislike the inland revenue. Fairly broad brush comment, but what I think The message they're trying to convey here is certainly the top one. Inheritance tax can be mitigated through careful financial planning and time. Alternatively, if you like, the flip side of that, a lack of knowledge, lack of understanding, and moreover, a lack of action, a lack of activity is likely to opt someone in to paying this voluntary tax. So we're going to try and look at that today. So in terms of planning, we've said that it is important. What options do we have? Spending, gifting, and insuring. So spending is quite straightforward, and it is a legitimate option for clients. Simply reducing the size of your estate by spending that money, enjoying it more. For instance, I don't know, more holidays. Someone's in agreement already. More holidays, for example. Sports car you've always fancied. Motorbike for some people in the future, or even turning left on the aeroplane when going on holiday. All those things can be extra spending that we can use all that. And sometimes with clients, it's difficult to get them to spend that extra money. But perhaps if people looked at things as if once they've got an inheritance tax liability, the government are effectively footing 40% of that additional bill, that might make it a little more attractive. So gifting as well, we'll look at gifting. We've already mentioned, if you like, gifts made by someone, if they then survive 7 years, are outside of the estate for inheritance tax. The government do allow some gifts to be exempt immediately, and we'll look at those as well. And then in terms of insurance, it's simply taking out an insurance protection policy against the likely liability on death so that it's paid from the policy. So, I'll go back one actually. If I assume that you can take care of the spending yourselves, that leaves us with the other two options to talk about today. So in terms of gifting, we look initially at the exemptions that are available. The government do allow some exemptions, not wholly generous as you would expect from the government, but nonetheless they are exemptions. We mentioned earlier the first one, spousal exemption, unlimited between spouses. The next one is the annual exemption. It's £3,000 per annum per person. So £6,000 potentially for a married couple. And interestingly with this one, if in one particular year this is not utilised, it can carry forward into the next year, making a total of £12,000. Gifts out of normal expenditure, again, unlimited. It's underused sort of exemption, but particularly with pensions coming into the fold going forward, that's one we will look at in a bit more detail, particularly in regard to pensions. There are other sort of gifts available, allowable on weddings from parents, grandparents, etc. And gifts to charitable gifts to charities as well. So we'll look at them in a little bit later on. But effectively, with all of these gifts, very important to maintain good, accurate records. You can do that on your phone as well sometimes. So maintain good, accurate records during lifetime, because the onus then is on the estate after death to prove to the Inland Revenue that these gifts were made and they were exempt at the time. You wouldn't want to leave it to your executors after your death, which could be 20 years after a gift was made, for example. So we did mention briefly the 7-year rule. So again, the person making a gift, if they survive 7 years, that gift is then outside of the estate for inheritance tax. What happens though if you don't make the 7 years, you pass away within that time. The gift automatically falls back into the estate. It's then potentially subject to IHT, inheritance tax, becomes part of the calculation going forward. The gift itself then is assessed against the available nil rate band at the time and in the order that those gifts were made in the past. Now, this can throw up an anomaly or two here, which we need to be careful of. I'll address that a bit later on, but it is possible to have gifts remain in the estate for up to 14 years if they're done in the incorrect order. So we'll look at that briefly later on. Again, with gifts falling back into the estate on death, taper relief is available after 3 years to reduce the tax payable, but it is only available for larger gifts over the nil rate band of 325,000, as we mentioned earlier. So just look very briefly at the taper relief. It only applies from 3 years onwards, and it only applies to gifts in excess of the nil rate band. So for the first 3 years, the tax rate payable is the standard 40% rate. Each year thereafter, it does fall by 8% per annum through to year 7, when it becomes zero taxation. As I say, the taper relief does reduce the tax on the gift, not the gift itself. So again, we need to be careful of that if that becomes applicable. Mentioned earlier about gifts out of income, and then being gift out of income being an exemption that we can potentially use in particular for pensions. The rationale for this exemption is such that the government don't wish to dissuade family members who are, say, fortunate enough to have a surplus of income, if they want to use that income to help other family members who aren't particularly as well off as they might be. They don't want to dissuade them from helping out other family members for fear of some potential future tax bill down the line. So this is where it comes from. In terms of the criteria required to meet this gift out of income rules, as the name suggests, it must be from income, normal expenditure. It is potentially unlimited if you had unlimited income, but as I say, it must come from income, so it can't come from cash, savings, investments, etc. It must be regular and part of normal expenditure. So I always think a direct debit is excellent in terms of maintaining records here. It's on the bank statement. It shows how much is going out and when it's being paid, and it shows that it's regular. So that's quite useful. And it cannot impact the standard of living of the person that's made the gift. So if, for example, they were giving up one holiday a year in order to pay money to their family, that perhaps wouldn't work. So you've got to be careful not to impact the normal standard of living of the person making the gift. And I guess the key point where I said pensions could be quite useful here is pension income and tax-free cash from pensions, if it's paid on a regular basis, does constitute income in this instance for gifting out of income. So again, that's where pensions come in, and we'll look at them in a little later on. If we look now at pensions, the fundamental question with anyone in retirement is pretty much, will I have sufficient assets to maintain my standard of living, to maintain my income capital requirements for the rest of my life? This question now is more important than ever with pensions coming into inheritance tax in 2027. So just briefly look at the position today. So I guess it's possible for clients to hold on to all their pension, all their retirement income, safe in the knowledge that if they did die with a surplus of pension fund, that pension fund could then be transferred to the next generation in an inheritance tax efficient manner. But as we've said and heard already, from 2027, that will no longer be the case. So it becomes very important at that point then to determine what part of the income we're going to need for the rest of our lives and what part is surplus to requirements. So in terms of, I guess this is where the balance comes in, trying to balance the assets between assets required for capital and income going forward in life, assets that are surplus and then could be gifted away, invested away in some form of inheritance tax friendly manner. And this is an area, I guess this being able to determine assets that are required for the future versus assets that can be gifted away immediately. That is something you can get help from your Greystone advisor. The advisors all have access to sophisticated cash planning tools that will look to the future, look to the pension assets, see how much of those assets are required to generate capital and income required for the throughout life, and then how much of those assets are then surplus, and then we can look at some form of inheritance tax planning with those surplus assets. Oh yeah, I'll mention that later. So in terms again of pension planning, post 2027, will pension planning be looked at differently with the new rules coming in for pensions being added to inheritance tax? So quite frankly, yes, straight away, pensions will start to, are already being treated differently. We're already hearing from pension providers that clients are looking to withdraw pension income, withdraw additional pension income, withdraw the tax-free cash as well, with a view to either giving those funds away or reinvesting them in an inheritance tax-friendly manner. So it's already changing sort of pension planning, and these rules are still to come in 2 years down the line. So we said that pensions will become part of the problem from 2027, but pensions in conjunction with perhaps the gift out of income exemption, perhaps the 7-year rule as well, we can use pensions as a positive tool, as a strategy ahead of the problems in 2027. For example, we mentioned about the providers already saying that this is being discussed and indeed happening. Additional pension income can be withdrawn from the pension, given that it's additional, it's surplus by nature. It can be then gifted away as a gift out of income. Equally, tax-free cash, that still constitutes income in this instance if it's paid out on a regular basis. So again, that can be gifted away under the surplus income rules. And we can also take tax-free cash from the pension if it's not required by the client. That then can be either gifted away or invested into some inheritance tax-friendly investments for beneficiaries in the future. Careful here with income in particular being taken from pensions, perhaps certainly in the first instance. Pension income, tax-free cash is fine, as the name suggests, it's tax-free, but pension income is potentially subject to income tax. It doesn't make sense to take excessive amounts of income withdrawals from the pension such that we might be generating, say, a 40% income tax bill if we are trying to save a potential 40% inheritance tax bill down the line. So that's just one thing to be aware of when it comes to withdrawing from pensions. Did just briefly mention it as we were going through the exemptions, and then just talk a little bit charitable gifts as well. It's not often considered part of planning in a way, but it is something that's available to people, particularly if you are charitable givers by nature anyway. So in terms of first thing, the charity itself has got to be registered in the UK for the rule to be applicable. Any gifts to those UK qualifying charities are immediately exempt from inheritance tax. They come straight off the top line of your estate before the inheritance tax is even calculated. In terms of the donation, if the donation to charity equates to 10% or more of the size of the estate, then the overall inheritance tax on the estate falls from 40% to 36%. Again, the government not the most generous, but nonetheless, it is a reduction in the inheritance tax cost. So if we just take a minute now to look at positives and negatives of gifting directly to individuals, family members typically. So there's no immediate inheritance tax charge. The gift then falls outside of the estate if you survive 7 years. As we said, also taper relief is available on the larger gifts after 3 years if someone doesn't survive the 7. Possible negatives, the person making the gift loses control of those assets, loses control of that money. They can't ask for it back in the future. They can't control or have any say in how those funds are spent by the people, by the beneficiaries of the funds. If the person does retain any sort of interest, so classically, people think they can give the house away as a gift for inheritance tax, still live in the house, survive 7 years, and that falls out of the estate. But because you're still living in the house, you've reserved an interest in the property in that case, the gift falls out of the estate, falls into the estate, sorry, for inheritance tax purposes. And also from the beneficiary, the person receiving the gift's point of view, the assets that they receive will immediately become their assets. They become part of their estate for matrimony, divorce, for example, bankruptcy. So again, careful with how we are gifting lump sums. We can gift 100,000, for example, to one of the children to save potentially 40% inheritance tax. That child then potentially gets divorced. We've lost 50,000, not 40,000. So we just got to be careful with that. So if we're looking at a way where we can either gift monies away or invest those monies in some form of investment in such a way that the person making that gift can retain some level of control, access, flexibility, and we can protect the potential beneficiaries down the line on divorce, etc. Is there a way we can do it? And I shouldn't have put that slide up straight away, but yes, we can do that by utilizing trust. So in order to, I guess, to understand trusts, we'll start with what actually is a trust. So a trust itself is a legal entity that can hold assets on behalf of another, quite simply. So in this case, we also have, in terms of the parties involved, the donor or the settler is the person establishing the trust, setting the trust up, and making the gift to the trust. The trustees are the people that effectively manage the trust during its lifetime, and they are effectively the owners of whatever property is in the trust for the time that it remains in the trust. The beneficiaries are essentially the individual or individuals that will eventually inherit the benefits from the trust. So we did look before about, we'll now contrast a little bit the pros and cons. We saw earlier the pros and cons of making a gift to an individual. Now look at the pros and cons, if you like, of making a gift to a trust. In this case, a discretionary trust. So we keep the asset, the gift, still outside the estate after 7 years. Taper relief is available also. The assets, as I said earlier, are effectively owned by the trustees, and distributions, payments out, are made at the discretion of the trustees. They are effectively the owners of the asset, and as such, the asset does not form part of the estate of the beneficiaries. So the beneficiaries themselves then are protected against divorce, bankruptcy, and even inheritance tax if they were to die as well. Possible negatives: there are potential inheritance tax charges on this type of trust, on the gift to the trust, but only where the value of the gift exceeds the nil rate band, 325,000. So there's a potential tax charge on the excess over 325 on entry, and then potentially a smaller tax charge on exit, and every 10 years that those funds remain in the trust. And as I say, but it only applies to those larger gifts. In terms of features that we're looking for, or settlers, clients are looking for with trusts, main one, I guess, is control. They're able to have control over the asset during their lifetime. They can determine who benefits, how much, when, etc. Potentially, there's some access. They can retain some access to the funds, receive some form of capital or income payment in the future. Flexibility, trustees taking the lead from the settlor. The trustees can potentially change the beneficiaries, the beneficiary proportions, etc. So when we look then at inheritance tax efficiency, it is possible to gift funds to a trust, with the trust then looking to invest those monies into an investment that is inheritance tax friendly. And I guess we'll now look at sort of 3 of those that offer varying degrees of control, access, flexibility, and tax efficiency. So 3, and I guess they're off-the-shelf trusts. They're widely available. We start, discounted gift trust, lifestyle trust, and loan trust. If we start at the 2 ends, I guess, to begin with, the discounted gift trust, as we see on the efficiency side, is very good for inheritance tax efficiency, given that some of the gift is immediately outside of the estate of the settlor, the person making the gift, possibly 40%, depends on the age of the person making the gift, with the remainder of the gift outside the estate after 7 years, the usual 7-year rule. The downside, if you like, of this one is the access. The money pretty much is locked up for the lifetime of the person making the gift, with only a small income being paid back to the settlor on an annual basis, generally around 4% of the total gift each year. The other end of the scale, I guess, is the loan trust, which has excellent access. As the name suggests, it's a loan trust. It utilizes a loan to the trust, not a gift, which the DGT offers. So because it is a loan to the trust, access for the settlor is excellent. Those funds can always be repaid at any time. But because it's a loan and not a gift, the 7-year clock doesn't apply. There's no inheritance tax efficiency after 7 years. And the only inheritance tax efficiency available is the inheritance tax free on any growth on top of the loan, but not the loan itself. So it's not great for inheritance tax, but good for access. Discounted gift trust is the opposite. So I guess we'll look in a bit more detail now at the lifestyle trust, which we believe offers the best balance between access and tax efficiency. So looking in more detail then at the lifestyle or reversionary trust, the original gift is still outside the estate after 7 years. So again, it's good for inheritance tax purposes. The investment bond is the underlying asset that's invested in within the trust. This bond is written as 1,000 smaller bonds, mini bonds known as segments. The settlor then determines how many of those segments they want repaying to them each year as, for example, an income going forward. It has to be paid on the policy anniversary each year, so there's no access in between, but each year you can get a certain percentage of the original gift paid back to you on the policy anniversary. In terms of that, the settlor then has the choice ahead of each of those anniversaries whether they wish to receive those funds, defer those funds, or potentially even assign those funds outside of the trust to one of their beneficiaries. And the key point here is that the original gift requires that 7 years, but any further deferments or assignments further down the line, the 7-year clock doesn't start again. It started on day one and doesn't apply thereafter. So just looking at an example of a lifestyle trust. So we're looking here to invest a gift of £200,000. The settlor, it is written as 1,000 segments, 1,000 smaller policies of £200 each, and the settlor has requested £20,000 being paid back to them on the anniversary each year. So that's effectively 10% each year for 10 years. It could be other figures, but 10% for 10 years is the classic example. So in year one, for example, policies A, B, and C could potentially be paid back to the settlor. They would then hold £20,000 of the original capital, plus any growth on that £20,000, investment growth, interest, whatever it might be. The return of the £20,000 is completely tax-free. Anything extra, the growth is potentially taxable for income tax, but only for those people that it would be 40% taxpayers. Now, if we stick with this example, in the first instance, we're going to get policies A, B, and C, 100 policies of £200 each, plus some growth, being potentially paid back to the settlor on the first anniversary. Now, in this instance, the settlor has determined that those funds are surplus to requirements and has instructed the trust that they don't require those funds on the first anniversary. This is where hopefully this works. Yeah. So in this instance, the settlor has deferred those 3 payments, A, B, and C, to year 2. So as we approach year 2 then, the settlor now has a choice to receive 6 lots. So what's that? 200 smaller policies, £200 each, potentially £40,000 on the second anniversary, plus any growth. But that could be deferred to years 3 or 4, 5, 6, or indeed 11, 12, 13. But it's completely up to the settlor. Equally, the settlor can also assign those segments outside of the trust, outside of the investment, to a beneficiary, say typically the children. The children would then own a bond, for example, worth £40,000, and they can keep that, maintain that, or indeed encash that as their circumstances dictate, and potentially at a more tax efficient level than would otherwise be. So I did mention earlier again, order of the gifts. So the ones we've just looked at would be gifts to trust. But we can also make gifts to individuals. If we make those potentially in the wrong order, the gift to the trust or the individual, potentially we could fall foul of the anomaly I mentioned earlier, where the gift remains in the estate for up to 14 years. It does require knowledge and good planning, careful planning in advance when making gifts to trusts and individuals. And again, that's an area your advisors would be able to help with. But yeah, just as a rule of thumb, we tend to make investments to trusts before we make them to individuals. But as I say, you can discuss the specifics with your own advisors. Okay, so we've looked at, well, very briefly at spending, but gifting and investing. So that now leaves us with the insurance option, insuring the liability, taking out a policy designed then to pay the proceeds to executors of the estate, beneficiaries, so that they can pay the inheritance tax bill. So if we look at 3 of these 4 policies, the gift into Vivos really only used for ensuring the gifts for the 7, so that we can survive if we don't survive the 7 years. But in terms of the other 3, they're designed to pay off the inheritance tax liability at death. So firstly, we start in the far top left is the guaranteed whole of life, which is a traditional classic policy in this case. As the name suggests, guaranteed. It is guaranteed to pay back a sum assured in the future. That's generally the projected inheritance tax bill, but it's guaranteed to pay that in the future for the payment of a guaranteed premium throughout lifetime. Guaranteed nature is excellent in that sense, but it can be seen as expensive. But nonetheless, it's still useful, particularly for wealthier clients, potentially with large liabilities and little other planning options to take. Reviewable whole of life uses a similar structure to the guaranteed whole of life, but in terms of the guarantees, it only guarantees for the first 10 years. And it's much more, therefore, cost effective than the guaranteed whole of life, but it only works, only guarantees for 10 years. It is possible to extend the policy on the 10th anniversary, 15th, 20th, etc. But naturally, you start coming across the same problem then with the cost of that, because it then is in line with the guaranteed whole of life. But nonetheless, it's very useful for clients for peace of mind, 10 years peace of mind when they take it out. It's cost effective, and it can be used to cover a liability, say, for 10 years, whilst other planning strategies could be investigated. And then third option, joint life, second death policy, standard term policy that you may be familiar with, life cover, mortgage cover, etc. albeit they would pay on first death. This policy pays on second death, and it's also it can be kept in existence to age 90. So so whilst it's a policy, it's relatively cost effective, but the guarantee can be extended to age 90. So it gives a good compromise, a good balance between cost effectiveness and length or guaranteed period of insurance. And we do have an example, I think, on the next slide, just to give an idea what those premiums might be for the three types of policy. For a standard couple, say age 65, non-smokers, with a £300,000 inheritance tax bill to insure. The guaranteed whole of life, say guaranteed, very good, but potentially the cost is an issue. £435 a month in this case. The reviewable premium, which does guarantee for 10 years to begin with, starts for the first 10 years at 48. So you can see the differential there in terms of costs between the guaranteed and the reviewable. And then the second death policy that offers a good compromise between guarantees through to age 90 and cost effectiveness, available at just over £200 a month. Now, again, you can decide with your advisor which of those is suitable for you, but whichever one you choose, you need to write the insurance policy in trust. And we'll just look at that next. So the benefits of writing an insurance policy in trust, and the first one's the key here. The proceeds of the policy on the death of the insured are paid to the estate, and they're not subject to inheritance tax or probate. No point having a policy for inheritance tax if the policy itself is going to be subject to inheritance tax. So it's outside of the estate for probate and inheritance tax. The trust itself also offers control during the lifetime. Speed is quite key because we're not going through probate. The funds are available much quicker to the trustees and then on to the executors. And because they're available quicker and as real money, as cash, the liquidity is good. They can then be used to pay off the inheritance tax bill and allow probate then to be granted. So finally, just a quick summary, a few key takeaways. I guess the main one is why you're all here today and we're speaking. Early planning is more relevant now than ever, particularly with frozen allowances, pensions being added to inheritance tax. It's very important now to review pensions, to establish how much of the fund is required during lifetime, how much is surplus to requirements, how much can we then gift or invest away for inheritance tax savings. In terms of those gifts or investments, certainly make use of exempt gifts where available, particularly for pensions, I would say, with the gift out of income going forward. Trusts are very useful to receive those gifts, to allow the settlor then to retain some control, access, potentially have some funds paid back to them in the future, and also for potential protection of the beneficiaries from divorce, bankruptcy, etc. It is possible to insure against the inheritance tax liability. Key point, only if that insurance policy is written in trust. And I guess just to complete, inheritance tax planning, I guess it's a complex area. We've seen it includes gifting, investing, spending, insurance policies, and potentially an interaction between all them. Again, it's best, therefore, to seek out professional advice where you can, particularly with your advisors who will know your circumstances and be able to recommend appropriate planning for yourself, planning tools for yourself specifically. I think that's everything. Okay for now. Thank you for listening. And I'll pass you over now to James to look at the discretionary investment proposition. Do you want this as well, you?
Right. Afternoon, everyone. Excuse me. Good start. Afternoon, everyone. Thanks for joining us, and to everyone on Teams. So obvious question: where does James and team fit in? That is the investment side of things that both Paul and Claire have mentioned, and we thought it's a pretty good opportunity to introduce you to our discretionary portfolio service. I know quite a number of you are already invested in our discretionary portfolios. You might know them as DFM. Those letters are used quite regularly. So the team. On the left-hand side, that's us. We've had some fresh mug shots taken in the last couple of weeks. So it's myself at the top. We've got Oliver and Mohammed, and they're investment analysts who certainly support me in the management of the discretionary proposition. So that's on the Greystone side of things. You'll notice a couple of other faces or caricatures. Barris Capital Management. So that is a firm who Greystone partnered with, essentially to give some on an external consultancy basis, really, with these portfolios, really to support us guys, but also stress the investment cases that we come up with. You know, what are we thinking in terms of how we want to allocate the portfolios, whether that be in stocks and shares or bonds, but then also the underlying investments that we allocate across these portfolios as well. So that is definitely useful having these guys on board with us. In terms of the portfolio, so I guess taking a step back, the word discretionary, you know, what does that mean? So in terms of portfolio, so there's advisory and discretionary. Advisory, you create a portfolio, it's issued. Greystone used to do that on a 6-monthly basis, but by the time clients have their annual reviews, there can be a bit of a lag between a new issue of a portfolio and having that reflected within your investments on your behalf. So the discretionary aspect of it really helps us be a lot more nimble to market movements. We review the portfolios on a quarterly basis, so 4 times a year. That's formally, but it is always an ongoing discussion amongst ourselves and with the couple of guys at Barris Capital Management. Asset allocation. You may or may not have heard these words used before. Asset allocation is really essentially means how are we positioning your portfolio. So in terms of asset class, there's 2 broad asset classes. There's bonds or equities is how we'd define them. Taking bonds firstly, so think of that's essentially a loan to a company. It can also be a loan to a government in terms of government bonds. But when we, in terms of a loan to a company, the definition is a corporate bond. So that's essentially a loan to that business for a predetermined length of time. And in return, you get a fixed rate of income from that bond. On the equity side of things, so think stocks and shares. So think the FTSE 100, any business listed on the FTSE 100, that's a stock. So we can also allocate portfolios to those types of assets as well. In terms of those 2 broad asset classes, we like to think of underlying investment strategies as either active or passive. So in terms of, we'll take passive first of all. So passive is a way of efficiently tracking a broad market. So think the FTSE 100 again, for example. If we were to say we're allocating a passive strategy in the UK, that would typically mean we're holding an investment strategy that aims to track the performance of the FTSE 100. It's also a very, very cost-effective way of tracking a broad market. So overall portfolios are roughly 2/3, a third passive and active. So that really helps us stay very mindful of the overall cost to you as investors within these portfolios. The other side of that, active. So where we feel that, we really want to allocate to a certain region, economy. Say again, I keep picking on the UK. It's a good example. So we want to allocate to the UK, but we think there's an opportunity there where an investment manager can deliver performance above that of the broad index. So we'd allocate to an active fund on that basis. They are typically more expensive than passive investments, but we think the benefit of, the opportunity of outperforming that index outweighs the cost difference of active versus passive. The portfolios themselves, so these are, like I said, they're reviewed on a quarterly basis. The discretionary powers, the discretionary aspect of it, gives us the ability to make timely adjustments to your portfolio as and when deemed appropriate. And they're we'll come on to that in a second. They're risk targeted strategies, these portfolios. So now I mentioned the broad asset classes, bonds and equities. I quite like this chart. Think bonds, the blue area, and green is equities. So as you'll see, so this is kind of a risk scale. So think we run 14 portfolios, and along here we're running up the risk scale. So low risk portfolios, you'd expect to see, or will see, a high proportion of that portfolio invested in bonds. Like I said, they deliver a fixed rate of income, so they're more secure over time and can be less volatile in terms of their valuation. So volatility, think the oscillations in the value of that investment. As we move up the risk scale, there's a greater exposure to equity markets. So by moving up the risk scale, there's a recommended longer time horizon for investment. And with that, we think portfolios are able to take the higher level of risk assumed by investing in equity markets. Just jumping back one slide, communication. So with our investors, like I said, we review these portfolios formally on a quarterly basis. And with that, we issue quarterly communication in terms of a brief economic and market update commentary. So essentially, what do we think is going on in the world and how do we like to structure the portfolios on that basis? And also a portfolio update. So whichever portfolio that you were invested in, essentially, how is that getting on? Are we comfortable with the levels of risk that we're taking with your investments? And also, are we comfortable or happy with the level of return that we're seeing across those investments? We've spent a bit of time building on the company website as well. So there's quite a bit of literature on there now in reference to these portfolios. We have actually recently done a bit of filming. A couple of us from our team, so myself and Oliver and Steve from Barris Capital Management, we've started doing quarterly videos as well. So we have just uploaded our first one to the website. So you should be able to find it on there. We are also going to issue a mailer to clients with a link to that video as well. Communication, that also works both ways. So there's obviously the client communication, but also the communication within the team itself, managing these portfolios, and with the underlying fund managers that we invest with on your behalf. So we're always in regular communication with them. Team at Greystone, the team at Barris, there's been quite a few emails back and forth the last few days with market moves, figuring out what's going on there. And essentially, joking aside, it's figuring out what is going on there. Are we comfortable with how we've positioned your portfolios? We were very comfortable at the start of the year with the level of risk being taken, and we've now seen an increase in market volatility. Are we still comfortable with that? Are there any changes that we think are appropriate to make on your behalf? And there's quite a good point here, actually. So on average, these portfolios will hold 25 individual investment strategies, whether that's bonds or equities. But for every one of those investment strategies, we've probably spoken between 8 and 10 to come to that decision. And on an annual basis, averaging about 100 calls a year with these investment managers. So essentially what we're trying to do is really build our confidence in these strategies that we're allocating to our portfolios. And then, so just moving on from that previous chart, which is the blue and the green, showing the grading in terms of what exposure you have to bonds and equities across the portfolio. This goes one step further and tries to demonstrate that within bonds and equities alone, there's actually quite a bit going on in terms of how we can allocate your capital. So within bonds, we've got a few shades of blue going on here. So we can allocate a bit of that capital to cash. It's really secure. You can actually get quite a good return on cash and savings at the moment. So it's worth incorporating within portfolios. We've got sovereign bonds here, so government bonds. Again, they're pretty secure asset to hold within portfolios. Corporate bonds also, we touched on that earlier. And then the green, we've got a few colours going on here, green and a couple of pinks. So that is equities, but global equities. So think the UK, the US, Europe, and also further afield in Asia and emerging markets. And the size of each of these bars is essentially a function of how much risk we're willing and happy to take on your behalf. Here we go. I always hum and ha about whether to leave this slide in. We won't go through it line by line, unless anyone's desperate. This currently lists every underlying holding that we've got in each of the portfolios down the left-hand side, and then across the sheet shows you the exposure that we're holding in each of these. So we won't dwell on this too much, but again, it just shows you how well diversified these portfolios are, and that really has been key the last couple of weeks, especially with Donald Trump and his tariffs, and then the reciprocal tariffs to those. So it really pays to be well diversified, certainly during these market conditions. And then finally, this is essentially what we're trying to create. So when we first started out, we launched these portfolios in March of 2023. We said to ourselves, right, we want these to be risk targeted, and essentially try, this dotted line here is where we're targeting these portfolios in terms of the level of risk being taken and the level of return that we'd like to receive or generate, on your behalf. And each of these dots, the blue dots, are each of the individual portfolios since March 2023. So overall, they've been pretty well aligned with this efficient frontier line that we've looked to achieve. So we're very, very pleased with the performance that we've been able to generate, certainly in upward moving markets, but also during the recent volatility that we've seen so far this year. This is quite a squiggly line now. So in terms of the bank, Greystone's client bank, we categorize each individual client into a broad risk profile in terms of how much risk we think you're capable to take, and also how much risk you're willing to take with your invested capital. The broad client bank for Greystone fits within kind of the mid-range of the risk scale, and they're classified as cautious and balanced types of clients. So what we've done is we've homed in on those two broad categories of clients. So this chart is since we launched our discretionary portfolios. The green line represents a typical cautious client. So if you were to go anywhere other than Greystone, this is what we think is the average performance that you would have seen since March 2023 for a typical cautious investor. And what we're trying to demonstrate here is with the dark blue line, the equivalent discretionary portfolio that we manage here. We've had some good consistent outperformance versus the average in the marketplace. And you can see this bit here, this is year to date. This is essentially Donald Trump with his tariffs. Clearly markets have come off, but the portfolios have held up pretty well versus that average. We're very pleased with the performance relative to the broad cautious kind of benchmark. This is, so again, I said the average Greystone client fits within either cautious or balanced as a risk profile. This green line here is representing the typical balanced client in the broad market. So I'll try and avoid this squeaky floorboard. So as you can see, markets have come off recently. The average balanced portfolio has come off, but our balanced equivalent discretionary portfolio has done quite well in upward moving markets, and also has held up pretty well in the recent volatility that we've seen. And we've got a third one now. This is the growth category. So again, a bit higher up in terms of the risk level, from cautious, balanced, and then to growth. Again, so in terms of growth, expect a bit more volatility, bigger oscillations in the value of a portfolio for a growth portfolio versus balanced, and then again versus a cautious investment. But again, we're pleased with the performance in both absolute and relative terms of our portfolio since March 2023 and through upward moving markets, and then again in the recent volatility, it's held up pretty well in relative terms. And that comes back to the point of remaining well diversified across portfolios. We never want to put all our eggs in one basket, and that average 25 underlying investments, that blend of bonds and equities has really shored up these portfolios year to date. We'll spend a couple of minutes on something called Responsible Future. So this is a range of portfolios that we've recently launched, October last year, in fact, to really home in on essentially that responsible themes across global markets. A range of 5 portfolios, and they're looking to focus on ethical credentials, which cover environmental factors, social factors, governance factors in terms of businesses themselves, and really help our investors. If they want their portfolio to demonstrate these qualities, then we have an offering for that. These portfolios are managed alongside those discretionary portfolios we've just been talking about, but with that overlay in terms of the ethical, the social, and governance aspects. In terms of how do we actually structure these portfolios, so we run a clear set of exclusions. So there's key areas, so things like controversial weapons, tobacco manufacturing, they're areas that we look to outright exclude from portfolios. In terms of limitations, so we look to cap exposure to specific areas where businesses derive their their earnings, their revenues. A good example I always use is Tesco's. So within limitations, well, in terms of exclusions, like I said, we exclude tobacco production. In terms of limitation, we limit the revenue stream that we want to be exposed to from tobacco sales. And I use the Tesco example. If we outright excluded revenue streams, it means we couldn't buy Tesco shares. And then avoidance. So there's still areas of whether it's environmental, social, or governance factors where data can be a bit sporadic. So we look to avoid as best as possible those areas. And then commitment. So again, we're in regular communication with the underlying fund managers that we invest with on your behalf. And really, we're trying to, well, identify trends in socially and environmentally impactful areas and looking for these managers to work with those underlying businesses to improve their ethical credentials. We're always looking for improvements across, but like I said, environmental, social, and governance areas. And this final slide just gives you, again, we won't try and read through it, but this just gives you a flavour of what's going on within the investment team. So this is something we're always populating and updating within our team. It just really tries to get down on paper what are our views, what are our opinions about what's going on in the world, whether that across asset classes, whether that's bonds and equities more broadly, or within certain economic regions, whether that's the UK or US. And again, this is kind of a key component of how we structure portfolios over time. And that is it from me. Hope that was useful. I'll hand back to Claire for a couple of minutes.
Just for clarity, the 100 index has just gone above 8,000. It's actually flexing delivered by pitch, isn't it? Right. So we can all start smiling.
Thank you. Hi. I'm only here to say thank you to everyone. That's the end. We've run over a little bit, so if anybody's got any questions, if you want to come and find Paul, James, or I at the end over lunch, you're very welcome to do so. There's feedback forms on your seat. We'd appreciate your feedback, positive or negative. This is only the second one that we've run, so any suggestions about what we could do differently would be massively appreciated. And that's it. Thank you.